What is DeFi? DeFi stands for Decentralized Finance, and I've been trying to tell my friends and family what is DeFi as a whole and how does it change the whole banking system in traditional finance. In traditional finance, banks and government control the money, and they control how much is printed and also the use cases of it. Banks and governments not only just print money, but they could stop your withdrawals from banks, stop you from creating an account, and also reject any loans that you apply to. It's even worse for businesses, as businesses have to follow a strict set of regulations and financial reporting for them to even open a bank account. If you're a business and you're getting tons of money into your bank account over time, the bank might flag it as like a suspicious activity and might even stop withdrawals coming from it, and it might affect your business operations in the long run. Traditional finance, as we know it as called TradFi in the crypto space, has many high fees that they charge the users, such as credit cards, personal loans, and even home loans. This is where DeFi comes in and solve all the problems of TradFi. DeFi is not controlled by any centralized entities like a bank or a government. It's a trustless system and also is censorship resistant, meaning that no one can stop you from depositing your money or transferring funds as well. The fees on DeFi is way cheaper than traditional finance, where banks and foreign exchanges might charge you an insanely amount of fees just to get your money transferred to your friend or even exchange money to another currency. But DeFi allows users to transfer money and also exchange money instantaneously at a fee of probably less than $2. To understand DeFi, you need to know that it's built on cryptography, blockchain, and by smart contracts. And this is how all of it works in DeFi. And if you do not know what these terms mean, I suggest that you go out and understand what does each of them mean before coming to this video, so you have a brief concept on how DeFi works and the technology behind it. Anyway, let's cut the bullshit and let's get right into it. So there's essentially 5 things you need to know about DeFi as a whole. So the first thing you need to know is stablecoins. Stablecoins are essentially tokens that are pegged 1-to-1 to the US dollar. This is essential because you need to trade your crypto assets to the US dollar without paying any high fees. If there was no such thing as stablecoins, you would have to sell your crypto assets like Bitcoin and Ethereum directly to a centralized exchange like COINBASE or BINANCE, in which return they will transfer you back your money in USD. This transfer will go directly to your bank with you sending your assets to them. However, due to banking clearing times, you probably have to wait 3 to 5 working days in order for you to see your money in your bank, and therefore it does take a lot of time for the money to come into your account for you to be able to spend it. Furthermore, exchanges like Coinbase would not give you an exact price of Bitcoin like how it was in the market and give you a spread and charge you a fee on the sale of your Bitcoin. And these fees and spreads that Coinbase would charge you would probably hurt you drastically, as if you keep on trading non-stop, you might even end up losing more money on fees than you profiting from the asset itself. Furthermore, tax regulators will know that you transfer a lot of money in and out of your bank account, and you might even have a higher income tax bracket just because of that. Now, this is where stablecoins play a crucial role in the DeFi space. It allows you to sell your crypto assets to US dollars for like less than a 1% fee. You could essentially sell your Bitcoin or Ethereum to a US stablecoin like a USDT, USDC, BUSD, or even DAI. This helps reduce the waiting time for funds to be transferred to your bank, and if you have this stablecoin in your wallet, you could actually use it to buy other assets instantly without waiting for the bank to clear. In the US and the majority of banks around the world, any movement of 10,000 USD between accounts will put out a red flag for your account, and the bank will need to verify where is this money coming from. However, if you had stablecoins in your wallet and you wanted to transfer any amount to your friend or family or even for something, you could do so without even being asked or proof of documents of where this money came from. So it does give you a big advantage when you want to transfer a large sum of money instantaneously and suffer very minimum fees. The best thing is that stablecoins do not need a centralized entity to verify the transaction, so you don't need someone asking you like, hey, where did this money come from? I need some proof of documents and proof of where you're transferring money from for me to even verify this transaction. Stablecoins will just allow the blockchain to verify and your money will be sent immediately. The second thing you should know that exists in the DeFi space will be lending and borrowing. As we know, in traditional finance, lending and borrowing plays a huge role in our financial ecosystem. Usually, banks require customers to put down a 20% down deposit in order to take a loan now. The worst case scenario is if you do not pay back your loan, you might even head to jail, or they might take your collateralized assets that you put down in order to back the loan up. However, in crypto, if you put 20% down deposit and take a loan out, there is a risk of people not paying back that loan, and people can just run away with the loan amount and just ditch their 20% down deposit. This was actually a huge problem in crypto, and therefore smart contracts are developed to help solve this problem. Lending and borrowing in the crypto space is a bit different than TradFi because smart contracts are needed to be put in place so have a trustless system, so therefore it protects the lender and also helps the borrower as well. Let's take two people for example. Person A wants to lend, but person B wants to borrow. Person A will go to a DeFi platform like Aave and deposit his assets to be lent out, in which return he will get paid out with interest whenever he wants to take it out. Person B can't just put down a 20% deposit and get a loan now. It does not work like that. Instead, person B would have to over-collateralize his assets. What this means is that for him to be able to borrow $100, he needs to put down $120 worth of assets into the platform in order to take out $100. In this case, if person B does not even pay back his loan that he borrowed of $100, he does have $120 in the platform to be able to pay back to person A with interest. Now you're probably wondering, if I had $120, why do I have to loan $100 in order to spend my money on anything? Let me give you an example on why this is useful. Let's say if you have 10 Ethereum, they are worth $100 each, and so total value is $1,000. So you go to this platform called Aave, you deposit your assets of $1,000, and you can take out a loan amount of 800 USDT. This loaned amount of 800 USDT, you can do whatever you want with it, you can cash it out, or even you can just trade with it. Let's say a few months went by and you kept trading with this 800 USDT. This 800 USDT suddenly becomes 850 USDT. You can go back to the DeFi platform and pay off your $800 loan and keep the $50 profit. And in return, you can get back your assets that you put down as collateral and still enjoy that $50 profit that you have made from trading with the loan. If ETH did went up over the few months that you put it in collateral, you enjoyed the upside of your asset increasing. So that's a good thing because you didn't have to sell your Ethereum in order to use the money. So therefore you can potentially enjoy the upsides of your assets increasing without for you to need to sell it. This essentially allows you to make trades and be more liquid instead of you selling your assets when you still believe the price will still go up in the future. However, the bad side of this is that if you had 800 USDT when you borrowed it out and you started trading and you made a loss all the way down to 750 USD, to be able to pay the loan back, you would have to pay off the full amount of 800 USDT. So therefore you need to top up an extra $50 in order to get your assets back. And if you do not pay that full amount back, you might end up just losing your whole collateral that you put down, and therefore it might not even be worthwhile loaning. This feature in the DeFi space is very useful as anyone can be a lender or a borrower, and you can earn interest rate if you do allow your money to be lent out. However, if you're a borrower, you need to be more careful and you need to ensure that you are able to pay back your loans, or you might even just lose more than what you have borrowed out. Now the third thing is decentralized exchanges known as DEXs. In real life, we will have to go through a bank or a foreign exchange in order to transfer our money or even convert our money to a different currency. By going through these foreign exchanges or even banks to transfer money, they would usually charge you a very high fee, and we do not know how much they're profiting from it, as they do not charge you the actual foreign exchange rate but rather give you a spread so they can profit off it. Let's say if you want to convert your US dollars to euros, you probably have to suffer a $5 to $10 fee on just exchanging your money to another currency. And this is where decentralized exchanges come in, where you can exchange your assets to another asset with fees for less than $1 even. This all works from smart contracts which are made by code, and these smart contracts are immutable, meaning that they cannot be changed. What I mean is that no one can increase the fees that are exchanged between these tokens, and also no one can stop you from making this exchange if you wanted to. An example of a centralized exchange in the crypto space would be COINBASE. COINBASE has a limited amount of tokens that you can trade on their platform, as because they need to follow regulations and also approve of projects and tokens listings on their platform. In which case you will have to buy the tokens from them and you have to pay a fee and a spread just to own the assets on their platform. However, a DEX like Uniswap, there's hundreds and thousands of tokens listed there, and anyone can list a token if they added liquidity to it. Furthermore, there are very little fees when you use DEXs, as you only have to pay a gas fee to ensure the transaction goes through, and no one can actually control your funds. So DEXs actually prove to be a great way for you to exchange money anonymously and also at very low fees. This essentially just removes the middleman and allows you to make the trade from the market itself. So it saves you a lot of exchange fees and also keeps you anonymous if you wanted to stay that way. The fourth one would be insurance. Now you're probably wondering, what, there's insurance actually on the DeFi space? Yeah, but yes, there is actually. Let's give a real world example. Let's say a farmer wanted to insure himself just in case of drought this year. So the farmer will have to pay an upfront fee plus premium for the insurance that he's gonna get. The smart contract will check that the conditions are met by checking probably the weather and also make sure there's no rainfall during a certain period of time to ensure that the farmer can get an insurance claim. To be able to do this, the smart contracts can't actually check the real world data, so that's why oracles were made. Oracles basically represent data that can't be fake, so therefore they'll probably get a weather report or something and make sure that the farmer is not lying when it did not rain. So let's say the smart contract did check the oracle and it did not rain for 90 days, then the farmer will get an automatically payout through the insurance claim without the farmer needing to go through a company to submit that claim if it was in the real world. Now you're probably wondering, where is all this insurance money probably coming from? This money probably came from other investors or even other people who wanted to purchase the insurance but ended up not claiming it as the conditions weren't met. This is similar to the real world insurance companies. The only difference is that without you submitting a claim to the insurance company and trying to prove the proof for it, there are smart contracts and oracles to help you prove to the smart contract that it did in fact happen and you can get your payout. Lastly would be margin trading. Let's say if you wanted to invest in a stock, you have to find a brokerage, you have to submit your personal details, you have to submit your ID documents in order to get KYC. After you KYC, then you can start investing and start margin trading. Let's say you wanted to buy Apple share at a value at $100. The bank probably agrees that if you put down 20% down deposit at a 5% interest per year, you can borrow $100. So you put down $20 with the bank and take out $100 in loan in order to buy the share. Let's say in a few weeks time, Apple does go up to $150 and decide to sell the share. Now you have $150 and you can pay back your loan of $80 and net the profit of $70. This is the power of margin trading, as you can put down a small amount of collateral and borrow more money with it in order to make more money. So this also happens vice versa, where if the share does drop to $80, you'll be automatically liquidated by the bank because the bank needs to get their $80 back and you probably also lose that $20 that you put in. This is essentially the same for DeFi as a whole. The only difference is that you do not need to provide any documents to be KYC to even start trading. And in order to do this in traditional finance, fees for borrowing these kind of funds are really high, and in DeFi they make fees very low for you to start doing this. DeFi basically makes finance systems more accessible for people worldwide and also make it for much lesser fees for people who want to use it. Personally, I feel like DeFi has a long way to go to catch up to traditional finance because smart contracts has to be more trustworthy for users to use and hacks needs to start getting less and less. Basically, platforms need to start implementing smart contracts that are more immutable and also solid insecurity-wise so they can't be exploited. Overall, they solve a lot of problems by exchanges and also transferring of funds and keeping you anonymous where no one else can control the funds that you want to transfer. I do think that in the future, banks and probably governments will start to adopt this system as a more quicker way for users to transfer money to one another and also exchange at a much cheaper rate. Businesses can basically transact from all around the world for very little fees and you don't have to pay so much for basically exchange rates or anything else. However, if you do have a different opinion on this, leave your comments down below. I'll take a read at them because I'm quite interested to see what other people think. Anyway guys, that's all for today. Thanks for watching and don't forget to like and subscribe for this video. Catch you next one.